Alright, welcome back to another video. Today I decided I would stop being shy and actually bring myself on camera. So last time was a little bit of a debacle. I was very tired. I've been doing my drill. All those other excuses. I've got a couple more excuses, but how do you guys like the new set? We got the new LED lights. Thinking about, maybe I should mix it up a little bit. Does the moon add anything? I don't know, it's kind of weird. Let me know in the comment section below, because I'm not artistic at all, so I tend to focus on this stuff. So anyways, let's just get right into the video. We're just chilling in the sweats today. It's Sunday. I'll probably release this on Monday. This topic came about because I posted a story on my Instagram, and I basically asked you guys, as stocks go up, they get blank. And the two options were more risky and less risky. And I followed that up with, as you get higher on a cliff, falling off becomes blank. And the options were more risky and less risky. And certain people texted me back or, responded to the story and said, why would it be more risky when a stock price goes up? So that's why we're going to talk about trading ranges today. But it's kind of hard to get people to click on certain videos if they don't know what they don't know. So anyways, without too much further ado, let's just go ahead and dive right into the topic. So trading range is basically within a given time, what prices has that stock traded at? So for Altria, as we can see, we've got 52.45 was the high that it hit, and we've got $30.95 was the low that it hit. If we look over here, this right here is basically when people speculated that Juul was going to cause a huge, drop off in business for Altria as a whole. If you don't know out there, Altria, they're the owners of Marlboro. They sell cigarettes, and they acquired much of Juul. And since there was the whole Juul debacle, people speculated that that the business was going to be worth a lot less. So the stock price went down. This dip right here is the general market drop that happened. Altria took a huge haircut there, and then we've got some price movement within this range. So the reason why Altria tends to be a typical trading range stock is because Altria is mostly a dividend play. They don't grow too much. They don't have really any growth at all. So most of the value that you get from Altria shares are from the dividends. So let's go ahead and fill in some of these right here. So this A right here, this is what we call a resistance line. So this is basically the top range of the trading range. So we call that the resistance because typically these typical trading range type stocks, they don't go above that resistance line because the market or the participants in it have a memory. They remember that that's as high as it traded at, so they tend to start selling around that resistance line. If you can break through that resistance line, then that's a bullish sign if you're a trader. But anyways, next one, support line. This one is basically the opposite. So over there we've got June 2019. Over here we've got June 2020. So within this year, the lowest that is traded is considered the support line. So if you break through the support, that is considered a bearish sign. And if you're a trader, then that means something. But we're going to talk about value investing today and the value of the actual business. See right here, as I wrote in, that is the actual trading range. So that's the range that it traded within, like we said. Okay, so let's go ahead and get into the next questions. So what gives the actual share its value? So what gives the actual share its value is going to be the profits, and it's going to be the underlying assets within the business. So we'll talk about that in a second. And speculation. So let's go ahead and fill those in really quick. All right, cool. So profits here. So basically profits is the rights that you have as an owner of the business. So if you own a business, if you were to own the whole business, you'd be very concerned, how much profit is this business making? Essentially, when you're buying a business, you're buying something that is a cash generating machine. So profits is what you're concerned about there. There's various ways that businesses will go about getting out their profits back to their shareholders, such as dividends or such as share buybacks, or even just reinvesting within the business and expanding their ability to make more future profits or more future revenues. But that's the profits component right there. Underlying assets. So let me give you the example that I like to give people. Let's say that this is my house here, and let's say that instead of just a house, it was Casey's Beauty Salon. So Casey's Beauty Salon makes a certain amount of profits. That makes my beauty salon worth a certain amount. Casey's Beauty also is this house. So whatever value of this house versus the amount that I owe on the house, that is the value of the underlying assets. So when you talk about your support lines down here, you can talk about book value, which is essentially what the assets of the business are worth. So a certain stock can only go so low before it starts trading below what the actual business, the physical business itself, is worth. That's part of the reason why you see support lines, besides just market memory and other market psychology factors. But part of the reason you see the support line is because if, let's say this house is worth $300,000 and I don't owe anything on it, and I'm making a certain profit per year, if I was selling shares of my company, the total amount that I could sell this business for should be at least $300,000 because the house itself is worth $300,000. So as you get down here and you get close to, let's say that this was my business, this down here it would have to be a little bit above $300,000, assuming I'm making anything of a profit. And just quick note on profits, if you listen to Benjamin Graham's theory, basically he says that you should try to buy businesses for cheap, around 15 price to earnings ratio or under. I tend to err on the side of lower than the industry average. So if the industry average for the industry you're looking at, like the airline industry or something, is 7 forward PE, then try to buy under that, and you know that the business is cheap within that industry. So we're not going to get into that too much, but anyways, let's get into the dividend and the payout ratio for Altria, the cigarette company. So the dividend for Altria is $3.36. So the reason why that is important to point out is because that's part of this profits thing over here. So if you're buying a business, you want to be paid out money, or you want to increase your investment. So if those dividends basically give this share a certain value, right? So $3.36 per year, as you can see over there, if you look at the $30.95, you're getting more than 10% cash back on your investment at the low end of this range. At that point, investors are going to step in and they're going to say, oh, I can make 10% on my money. I'm going to hop in there. Up here, that's going to be a little closer to 6%, if I had to guess, 6-7% at the top of this trading range. So investors are a little bit more skittish, so that maybe they start to sell off the shares, or maybe they're not as excited to buy the shares. So when you basically, what happens is, as you get up here higher, if there are fewer buyers, just as with anything else that's trying to be sold, like if I was trying to sell you this sweatshirt, if I couldn't sell it to anybody, I'm going to have to drop the price. That's how it works in the stock market itself. So as you get up higher, things get more risky because it's harder to sell those shares to the next person because they're less willing to buy them at a higher price. And this payout ratio right here, this is important because this has to do with the speculation of the share. So as you get to a higher payout ratio, so this is an 80% payout ratio, the last time I checked Altria, they're paying out 80% of their profits. So that means that if Altria's profits dropped by 20%, they would not be able to pay this out. So a more reasonable payout ratio for Altria would be something like 40%. So if you assume that this is cut in half, instead of that paying 10% at the low of the trading range, then that would pay 5% at the low of the trading range. So that's what traders are looking at. They're looking at, well, this would be more reasonable if they paid half of this dividend. So we're going to discount this dividend to basically be 5%, or what's that, about 150, 160. So they're basically discounting the dividend to be about 160. That's why it can get to such a high yield, because people don't trust this payout ratio right here. So they're discounting it. Okay, and so why does it move? We pretty much just answered that. It moves because of speculation. It moves because of speculation about the underlying assets. Like Juul, they assume that Juul's value is going to go down, or maybe they're going to get hit by regulations. And it goes down and up because of speculation about the profits, and just speculation in general. Things that come out in the news, things about the products, the actual brands have value, and speculation about what's going to happen with the brands, speculation about what's going to happen with the overall industry. So anyways, hopefully you guys get some value out of this and understand a little bit more what a trading range is, why it's important, even if you're not a trader, even if you're just a value investor, hopefully you guys like the new set. I seriously do want you guys to give some feedback on it. What do you guys think? But anyways, I'll see you guys in the next video. Make sure you guys hit the links down below if you want to support the channel. Thanks for everybody who comes out to support the channel and just watching the videos, watching to the end, people who enjoy the quotes. I'm rambling at this point, so I'm just going to shut up, and I'll see you guys